Morning, Market Chameleons and my favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
I'm going to jump right to the disclaimer.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
Okay, I'm going to share my screen. So I think we'll continue with, customer Q&A day, question and answers. You could put your questions in the live chat there on YouTube, but better if you want to ask your question live, that's even better. And it helps us a lot, it helps other people in the community to hear the question, kind of learn from traders' experiences. So Will's going to put a link there to Zoom. If you click on that link, it takes you over to Zoom. If you raise your hand, we're going to bring you on live. You don't have to put on your video camera, but we'll hear the question and we'll be able to ask about any of the surrounding circumstances around the question. This way, we get a chance to better focus on that question. So today, it's your chance to ask any questions. It could be about certain experiences in options trading, strategies that you're using, analytics, tools, so anything you ran into that you may have not expected. You could ask that question, and we're going to try to answer best we can, especially from anything from our experience. So while we're waiting for any questions to queue up, I'm going to just start maybe looking at what's going on in the pre-market hours. I do have questions that to fall back on from either I get through emails, through chat, or through previous shows. So if no questions appear, I'm going to start on those. Okay. So
Excellent.
Let's take a look at the market report.
Hey, D, your computer's reverbing. You're going to have to log out and come back in.
Okay.
All right. So as D cleans up his computer and comes back in, I was going to post in the chat. He's doing a webinar today. Well, we both are at 2 o'clock, but it's mostly D. IBKR, using open interest for trade ideas. So he's doing that today, 2 o'clock on Interactive Broker. So that's another site. You got to go on there and register. What's Mike saying? It was recommended by another analyst, Tony Zhang. Love Tony Zhang. Options. What's his site again? Tony Zhang. I know he's on CNBC quite a bit. He's an interesting guy. Also, I put the link in there. Remember, Gene said we can all vote once a day for the Benzinga Global Awards. That is something we were just recommended for. So that's always a nice thing if that pops up and you can vote for that. D, are you back?
Yep. How's
all right,
that sound?
perfect. Yeah,
okay.
Sound good.
All right, so this pre-market report, these are stocks trading in the pre-market hours. We have the most active stocks, the biggest percentage gainers, biggest percentage decliners. Coming down here, just to take a look at the list, I got 109 stocks that made our percentage gainers list, 42 on a percentage decliners list. From that perspective, it looks like a more bullish bias at the open. Let's take a look at the higher market cap stocks to see if we're getting a different picture or the same picture. So I'm using this market cap filter. Let's look for stocks 20 billion or higher. Here I see 18 on a percentage gainers list, 8 on the percentage decliners list. So not a lot of stocks making the list, but at least it looks a little bit more of a bullish bias at the open. Let me see. I don't see anything sticking out that much. I'm just kind of like eyeballing the volumes here and just the top ones. KSU trading 36,000 in pre-market, SYY 51,000 shares in the pre-market. So nothing big, not a big. I'm not seeing any big volumes right now. So unless there are questions on the pre-market, we could move on. If there are questions popping in, Will let me know.
Oh, well, we had one question. I'm trying to dig deeper into it about Wells Fargo.
Okay.
it was something that popped up on, I guess, CNBC yesterday. One of the options action individuals, Tony Zhang, was mentioning it. And I was just wondering what maybe was showing up on our trade ideas for WFC right now.
So WFC.
Yeah,
And
Wells
so
Fargo.
it was like a particular.
Yeah, it was Tony
trade
Zhang. I think he's got a website out there that gives options idea, and he's on options at action at least once or twice a week.
I still don't know what the question is though.
He was asking about Wells Fargo trade ideas, if anything's showing up on our site.
Okay.
The
All
trade
right,
cards.
that's very general, just looking at the trade cards. Okay.
Yeah.
So is it looking like for what, like a bullish bear? Was there any other?
I asked. I didn't get anything else yet.
All right. I mean, it's a very general question. Obviously, it depends on what your outlook is in Wells Fargo. If you're looking on a bullish play or bearish play or a volatility play. So very difficult when it's so general, and I can't, pinpoint what you're looking to do. So I'm just looking right now, Wells Fargo, and these are just trade idea cards that are coming in, filtered from, our different spread screeners. So you could look for, screen out for.
I did get more color. Remember, it's like a 2 to 3 minute delay. Okay. So he was suggesting, this was the analyst on options action, a bullish play in Wells Fargo. And the individual who's talking about it is thinking he's going to try a credit put spread is what he's looking at. So,
okay. So let me see if we could find anything. This is a credit put spread. So just so everybody knows what a credit put spread, that I'm assuming that he had a thesis for, being either, long to neutral in Wells Fargo. And he's looking at a credit put spread, which is selling one put and then buying a put in the same expiration with a lower strike to stop you out in case the stock really goes down far. So I'm looking at our trade ideas here, and in the strategy I see here, I just pulled down and picked bull put spread, credit bull put spread, and two of them were filtered out from our preset filters in the credit put spread screeners. So you could go in here under screeners, look at bull put spreads. That will allow you to use your own filters, but these are using the preset filters as starting points. So here I see two of them. One, it filtered out August 27th expiration, selling the 48 put, buying the 47 put. So this is a dollar put spread for a 31-cent credit using historical stock behavior. We look at what we think this put spread is theoretically worth, and we have a theoretical value of 20 cents. In other words, looking back in history and how the stock behaved, on average, the end value would have been 20 cents given the similar circumstances, with strikes same distance away from the strike same distance away from the spot price, same amount of days to expiration, implied volatilities in the similar levels, taking out any kind of earnings effects if there are no earnings. So looking at generating a theoretical value, we see that, on average, the end value is 20 cents. If you could sell for 31 cents, theoretically, it's a 11-cent edge or 16% edge based on amount at risk. And historically, a similar spread at 31 cents would have been profitable 76% of the historical observations. Okay, so we're talking about, theoretical values based on historical data. So that's one bull put spread. Another one here that it filtered out, same expiration, but this one 48, it's on the 48 strike, buying the 46 strike. So it's looking now at the $2 put spread for a credit of 55 cents. We think based on historical stock behavior that the theoretical value is 36 cents. that's what, like about a 19-cent edge, or 13.1% edge based on the amount at risk. Historically, looking at that stock behavior, selling it at 55 cents would have resulted in the spread being profitable 84% of the time. Okay, so if we kind of just clicked on this on the options chain, we could go there and it sets up that put spread. So here we go. So right now it automatically goes to the August 27th expiration. This is the options chain with the calls on the left-hand side, puts on the right-hand side. So what it did was it populated buying the Augie 47 put. So here's Augie 47 put, 65 cents. So it's assuming if you're getting an immediate fill, you're paying the offer 65 cents. Then selling the Augie 48 put, the one above it, for 96 cents over here, right? So you're buying 65 cents, selling 96 cents. Let's load that strategy. And we could see here that credit of 31 cents, midpoint 35 cents. So, you know, you want to get it as close as you can to that midpoint. If you could get it above the midpoint, even better. You know, usually that's what, at least if things are trading in the right way, you might be able to, especially if you see order flow flowing one way, selling one put, buying the other, you might even be able to, but that's your job to kind of research and fish for that. But keep in mind, you know, closer to the midpoint, the more it is, even though it doesn't look like a lot because it's 4 cents, you know, so instead of selling at 31 cents, if you could put a limit order, get it 35 cents, that's 4 cents, but on a dollar put spread, that's a large amount, especially what do you have at risk here, like 65 cents. So you can see there that that's, you know, 5-6% of the spread that you have at risk. Here we see this is the payout diagram. So if the stock kind of just stays here, 48.65, or goes higher, then both these puts, the 48 put and the 47 put, expire worthless, and you get to keep the entire credit, right? Whatever you sold it for. If the stock goes down a little bit, you know, as long as it stays above 48, same scenario, they both expire worthless. You get to keep the credit. If the stock falls below 48, right, then this put at expiration starts being in the money. So you got a little bit of cushion because you collected a credit. So in this case, 31 cents. So your break even is 31 cents below 48. After that, it keeps going down. It starts losing. And finally, you're stopped out below 47. So there your max risk is whatever the credit is, you know, that you receive, and then the distance between the strikes. So here you would be losing 69 cents if you sold it for 31, right? You got to buy the put spread back for $1. You receive 31 cents, 69 cent. It will be a 69-cent loss in this situation. Of course, if you could sell a little bit higher, let's say you're able, let's take a look at this whole thing will shift. So the 48 put, we see that the spread is 96.98. So let's just say we're able to sell this 98 cents. And the 47 put, the market is 61 cents 65. So instead of 65, we're able to buy it at 63 cents. Reload that strategy. So you see here now we got 35 cents credit. So up here now, you know, our profits, obviously now we can profit 35 cents if both these expire worthless. But on the downside, since we received more, right, then our downside now is not 69 cents, but 65 cents. So we buy back the spread at $1, but we receive now 35 cents at the initial trade instead of 31 cents. So we reduced, right, our max loss. And and we increased our max gain. Does that make sense so far? Any
Yeah, it
questions?
makes a lot of sense.
Okay. The Theo, right? Distribution Theo, you could come here. We're using 4 years of data, and it's using here a dynamic IV range. So you could see here in the last 4 years, 14 days to expiration. There's 25 observations with using that dynamic implied volatility. So here we see that right now selling at 35 cents. Theoretically, we think it's worth 20 cents. That's a 15% edge. Historically, at 35 cents, this would have been a winner 80% of the observations. If we used all implied volatility ranges, if implied vol was high, low, doesn't matter if it was close. It's just, so there's 54 observations. So there we're looking at the implied value, the theoretical 32 cents, okay, with a historical probability of success 66.7. Again, you have that data there to move around. You could change the amount of years, to more or less. We could take a look at using data in the last 2 years. The theoretical value is 28 cents with the 69.2% success rate. If we go up more years, 6 years, for example, Theo's 34. So remember, there's no one right data set to use. It's up to you. We kind of defaulted to 4 years, but some people like to use less to focus on more recent history. Some people like to expand it to look at more observations. So that's up to you. We defaulted to 4 years.
We did have a question from Robert when you were looking at the trade cards, and it came win rate versus theoretical edge. He was just wondering, is there a general rule or some thing that you particularly look at when you're looking at win rate and edge when you're looking at a trade setup? Is there anything you do in particular when looking at it? Basically is his question.
So yeah, let me go back to the trade card then. So we have it kind of in front of us. So when we look at a trade card, we have two basic statistics here, right? Let me bring up that bull put spread. Oops, sorry. Bull put spread. Okay, I'm on there. So we kind of have two statistics here. One is a theoretical edge. One is the win rate. They're telling you two different things, right? So it's not that one is more important or you should ignore one and just focus on the other. Otherwise we wouldn't even put it on there. It's just telling you two different things. So one is just telling you the frequency of outcomes, right? And this is how I usually describe it. I'll say, look, let's say you have a wheel, right, with 10 numbers, right? And if I tell you, if you bet on any number, if you make a bet, any number from 1 to 9, 1, 2, 3, 4, 5, 6, 7, 8, 9, that then you'll win the bet, right? So basically, you bet $1. If it lands on 1, 2, 3, 4, 5, 6, 7, 8, 9, you win. Okay, so what is your win rate, right? Theoretically, you should win 9 out of 10 times. So that's 90%, right? So that's the frequency of you playing and winning, right? A coin flip is 50%. If I give you one out of what I just described, it would be 90% win rate. But what if I told you that, if it lands on 10, you have to pay me $1 million. Well, all of a sudden now things reverse, because now you don't have an expected positive return. You have an expected negative return, right? Because you're going to win 9 out of 10 times, and maybe I'll pay you $1, but the time it lands on 10, you pay me $1 million. You're going to, statistics say you're going to be out of business, right? Doing that. So one is kind of telling you what's the expected value, expected return. The other is telling you the frequency of wins. Okay. So two different things, that you're looking at. Now, when I give you a wheel, 1 out of 10, that's a little bit easier because you know all the possible outcomes, right? There's only 10 numbers that it could land on. Stocks are not the same way. There's too many variables, dynamics, so we create estimates using models, because a stock you can't just say, well, here's a stock today. In 2 weeks, there's only 10 possible outcomes. It doesn't work that way. It could be an infinite amount of outcomes. So we use historical data, behavior to create a model making estimates. Okay, because that's the next best thing that we could do without knowing all the possible outcomes. Does that help with the?
It sounded like it should help. We'll see what Robert comes back with.
Okay. Any more questions?
That answers my question. He says thanks.
Okay. Thank you.
Well, we did have a question, and it was a deep two-part. Well, it was 2 questions, or a question and explanation from Albert, who's a pretty regular chameleon. He's asking, do we have a screener to search for highest gamma expiring at the next expiration? And he refers to something as the key gamma strike. And then he gives his thesis why he wants this. The thesis is the stock will pin around, and he gives a symbol, I guess,
KGS
going into expiration, act as a magnet, compressing volatility. The volatility.
What's the symbol? I'll just turn on.
I think it's KGS.
KGS.
I think that is a.
Actually,
I think it's Kansas. Is it Kansas City Southern? I didn't look at it.
Okay. I mean, I don't see that. I don't see a KGS, but okay.
Maybe that's an acronym I'm not picking up on. I did ask him to come on if he wants to come on live to speak about it, because it seemed like a pretty.
I think this would be, and it's fun. I know it's hard to come on live. It's scary, but you don't have to turn on your video, right? But it helps because you're asking a question that it's not very straightforward what you're looking at. It's not as simple. So I'd like to be able just to maybe ask you what you're looking at, what you're thinking, and then I'll be able to maybe help you better, because I wasn't clear what's the thesis behind it.
I guess it's KGS is an acronym for key gamma strike.
Okay. All right. So it's not a stock symbol. It's like
no.
acronym.
That was I was reading what.
Okay.
So he's thinking that there's going to be a vol collapse around the strike, the next expiration out around the strike, which sounds like the highest. Well, actually, I'm jumping to conclusions. I don't know exactly what he's.
The problem is with a question like this, we have to start making assumptions, and we don't know. We don't really know. There's too many surrounding circumstances. When you're looking at options, think about it as look, I'm looking at the board here, right? All these different options here with different open interest, different volumes, different implied volatilities, different expirations. What are you trying to do here? Here, I'm looking at Wells Fargo. What does that mean? Key gamma strike. I don't know what that means. When you're thinking about Greeks, okay, gamma, delta, vega, okay, all these Greeks are a snapshot in time, but they all change. They're dynamic. They're going to change as the market changes. They're going to change as the stock changes in price. They're going to change as the implied volatility. They're going to change based on decay. So these Greeks, the stock will open up at a different price. During the day they decay, implied volatilities was change, and the whole picture changes. I'm not sure by key gamma strike I'm not sure what that means. Maybe if you could come on, just kind of explain.
Well, listen, we only have 5 minutes left, and Albert did say he will come on live. I'd hate to have them come on live and then not be able to answer the full question. So do we want to?
If you come on, let's walk us through an example.
Dimitri, you just went underwater again. Your mic picked up the reverb. So you want to log out and come right back in real quick?
Yeah, let me do that.
All right. So Albert, you can email me, williammcbride@gmail.com, if you need directions on how to get in, but really you just have to click the link, come on over. I should be able to see you. There's an option in there to raise your hand and we'll get you on. If you can't come on tomorrow, next day, whenever you come on, or you can email me to set it up. I'll put my email right now and tell me when you can do it. So we'll set up for it. There's my email. You can just email me. Everyone, thank you for voting. The Zynga FinTech Award. Be nice if we won. We got a late start. I know that people have been up there for 2 weeks already. They just emailed us and asked us in. So anyways, vote for that. Oh, sorry.
Yeah, and I think that question, the best way is if you could walk us through an example, right? Just walk us through, here, I'm looking at the board. You could pick a symbol. We'll look at the options chain and just kind of walk us through the example and the thought process. And that actually helps because this is something that may even change from symbol to symbol, right? Or may change based on like different factors that come into play. So that would be actually very helpful, right? Just walk us through an example of one. Like if you have a, what do you call, key gamma strike, if you have one in mind, we'll focus on that particular one. And I think that will actually benefit all of us.
Great.
Right. Well, yeah.
So we'll try to do that. I put my email out there. You can email me. We did at Alex Abba. He's a new chameleon, just popped on today. He has a question about doing an initial screen for spread strategies.
Okay.
Where would he find a video on that? Probably just go to YouTube and search.
Yes. So yes, you could, if you go to YouTube and search like Market Chameleon credit put spread, you're going to see a bunch of them pop up, or whatever, Market Chameleon, time and sales. But here under the help, we have video guides here. So if you go under help video guides, you could do options, earnings, stock, like under options trading. Here's strategy screeners. So, you have videos on all of them. Let's say credit put spreads. This will bring up, there it goes. See a bunch of different videos on credit put spreads. Like that. So under here, also under here videos, here we tried something, we put every day that we do the videos, we kind of just keep a library here so you can go back, see. So we've been doing a lot of customer Q&A, but other days we did on trade ideas from open interest, earning trade ideas screener, large increase in open interest, like this kind of, so you could go back and take a look at some of our daily pre-market shows as well.
All right, he's thankful for that. All right, we're right at the open in Belldy. Great job, Albert. Hopefully you can come on in the next couple of days. Let me know with an email or just come in and we'll get you on earlier in the show to ask that question. I think every chameleon out there would like to hear it. I don't know if I announced, Dimitri has a show tonight or today at 2 o'clock using open interest for trade ideas on Interactive Brokers Network. So everyone can click the link I'm going to put in and register. You have to register on the Interactive Broker site to join that webinar. Right, D?
Yep. So 2 o'clock today, Interactive Brokers. We'll talk about open interest. Hope you guys could make it. Join us there. Also, we'll be able to ask questions on there. They have a live chat, I think, as well. So yeah, hope to see you guys there.
Awesome job, D. Thanks so much. Have a great trading day, chameleons.
Thanks, everyone. Stay safe out there. Have a good trading day and hope